bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the October 14th, 2025 episode. If you're watching on YouTube, you can see that we have a full panel today. My guests this week are my partners, Brad Elphick from our Atlanta office, Tony Grappone from our Andover, Massachusetts office, and Dirk Wallace from our Dover, Ohio office. In today's podcast, we're going to take a look at the tax credit equity market for several community development tax incentives. Specifically, we're going to look at the low-income housing tax credit, the new markets tax credit, the historic tax credit, and various clean energy tax credits. This is our third annual update, and this year, we have some notable differences in some of our credits, which will make this discussion particularly interesting this year. The most significant factor is the various changes that came out of the One Big Beautiful Bill Act that was signed into law on July 4th. Now I say changes because there was a mixed bag for the various tax incentives we serve here at Novogradac. I'm sure all of our listeners know that the low-income tax credit and the new market tax credit got good news. The forward housing tax credit was expanded indefinitely, and the new markets tax credit was also made an indefinite part of the Internal Revenue Code. The new market tax credit was scheduled to expire at the end of this year. Unfortunately, clean energy suffered a hit, with some key expiration dates being moved up quite dramatically. Now, this is a topic that I've followed closely, as you would have guessed. It's something that affects all of our clients and obviously the industries and the broader investment landscape. To that end, I've written about the overall tax credit market in various ways, multiple times over the summer in my column in Novogradac Journal Tax Credits. In one article, I discussed how to expand the base of investors. I also listed in another one tax and regulatory updates that could boost investment. And very specific to today's discussion, I also gave an overview of the road ahead for these various community development tax credits in the equity markets. Now, to give you a bit of level setting or broader context as to the size of the marketplace of tax credits, we at Novogradac estimate that the federal community development tax credit marketplace is roughly $80 billion this year. And that will be changing in coming years, as we'll discuss in the course of the podcast. And you may be wondering what makes up that $80 billion plus or minus. Well, clean energy tax credits are roughly 45 to 50 billion of that amount. And the low-income tax credit makes up about 25 billion in that 2025 estimate. And that 25 billion for low-income tax credits is split roughly 11 billion in 9% allocated credits and roughly $14 billion for productivity bond financed 4% tax credit transactions. Now, the new markets tax credit is scheduled to have a $10 billion award round this year, but we obviously do expect those to roll into 2026 and 2027. And the current market is based on a reset allocation award of $5 billion in allocation authority last year. And at a 39% credit rate, that's about a $2 billion market in tax credits. Now, I should note everything we're talking about here are the actual tax credits, not the tax equity, because that'll be a function, a percentage of the tax credit, either less than $1 or more than $1, depending upon what other attributes are being sold or transferred with the actual tax credit. And that's for another podcast to go into all those details. We have covered it in prior podcasts. And then I also wanted to note the historic tax equity market is just over $1 billion per year. And that's based on data provided by the National Work Service. So in total, roughly 2/3 of the community development tax credit market is made up of clean energy credits, with just over 30% going to LIHTC, long-term housing tax credits, and the balance going to new market tax credits and historic tax credits. Now, in today's podcast, Brad, Tony, Dirk, and I will discuss each of these tax credit equity markets, and we're going to focus in part on what's changing in the wake of the One Big Beautiful Bill Act. What's happened in the past isn't necessarily going to happen in the future based upon the One Big Beautiful Bill Act. And then along the way, there are some hot topic questions that we think are important to our audience. We know it's important to our clients, so we're going to discuss them. First of all, we want to cover what's the current pricing look like and what are some of the key factors affecting current pricing. And then we're going to talk a bit about what's ahead for tax credit investor demand. And then we'll also focus on, to the extent that clean energy tax credits do wind down to a certain extent, they decrease, but they certainly don't go to zero, as we'll talk about more, what that might mean for other tax incentives. And then we're going to close with something that's probably the most important, and many of you might be thinking you should lead with it, and that is steps that developers, sponsors, community development entities, and others, steps they can take to improve tax credit equity pricing. So as you can hear, or as you can see, if you're watching on YouTube, there's a lot to discuss. So if you're ready, let's get started. So Brad, Tony, and Dirk, welcome back to Tax Credit Tuesday.
Hey, thanks, Mike.
You're all veterans
Thanks,
of the podcast, not just as guests, also as hosts. So thank you all for participating in the podcast so frequently. Let me start by having each of you introduce the various services you provide to clients. And I'll start with you, Dirk.
Great. So I work in the loan closing tax credit industry. I work with LIHTC developer, LIHTC syndicators in audit and tax capacity. Also provide various consulting services. I provide cost certifications for numerous states across the country. And what's important for this podcast, and then also hit up our LIHTC working group, which addresses legislative and regulatory issues within the industry.
Great. Thank you for that overview, Dirk. Brad, why don't you introduce yourself?
Yeah, so I work also in the LIHTC industry, but also work in new market tax credits and historic tax credits, doing a lot of the same services Dirk just described on the accounting side, audit and tax and other test services. Also, we do a lot of transaction advisory services, helping prepare forecasts for many of the transactions that we do. And similar to Dirk, I also lead the new market tax credit working group.
Great. Thank you, Brad. Okay, Tony, bring us home.
All right. So I've been working across all the major federal tax credit programs throughout my entire career, but here today, I'm going to talk about my experience with the renewable energy sector. I oversee 3 different silos of services, one geared towards transaction advisory, another geared towards financial statement audit related services, and a third focused on tax return preparation.
Great. Thank you, Tony. So Dirk, let's start with you. Let's begin the discussion with the low-income housing tax credit. Just to level set, please briefly describe for our audience the 2 key changes made in the One Big Beautiful Bill Act that affect low-income housing tax credits, and probably more importantly, the supply of low-income housing tax credits in the future.
Yeah, as you pointed out, there are two main provisions that did impact the supply. We have 2 types of low-income housing tax credits. We have 9% credits and 4% credits. The first provision impacted the 9% allocations, and that was, I say restoring, but really, if it was restoring, it would be a 12.5% increase. So we'll say there's a new permanent or indefinite 12% increase in the 9% allocation. As many of you may remember, from 2018 to 2021, there was a 12.5% increase, but that did expire at the end of 2021. So a lot of folks in the industry were pushing to get that restored, and the One Big Beautiful Bill Act give a 12% increase in 9% credits. The other change is on the 4% side. The financed by test, or the 50% test, has been reduced to 25%. And that is for bonds that are issued in buildings placed in service after December 31st of 2025. So starting in 2026, we have a new finance by trust, which should free up some volume cap, especially for those states that are volume cap constrained, which should lead to an increase in the supply of 4% properties and 4% credits.
And what are you seeing right now in terms of equity pricing for low-income tax credit transactions?
So I've heard a few different phrases thrown out there: price discovery, price exploration. A lot of investors are looking at it saying, okay, we're at the end of 2025. We've entered the 4th quarter. These 2 provisions that impact supply are taking effect in 2026. So obviously you're looking at pricing now, knowing there may be this increase in supply starting in 26. Investors are factoring in other provisions that are in the tax code like bonus depreciation and things like that. So pricing is somewhat holding steady from what I've seen and what I've talked to you on the investor front. Given a range, your CRA properties are probably still in the upper 80s to 90% range. And then for other properties, maintaining in the low 80s, maybe even high 70s on some LOIs. But and in that lower 80s range, it's still where I'm seeing prices right now for next bit properties.
And what's been the impact of Fannie and Freddie? They had their cap increased from $1 billion a year to $2 billion a year, effective when it was announced. What impact is that increase in Fannie and Freddie's ability to an authorization to invest in the low tax credit market having on equity pricing?
And I think that is helping to stabilize at least 2025 a little bit, because as you pointed out, it was effective immediately when it was announced back in August. So going from $1 billion to $2 billion, having Fannie and Freddie getting that increase certainly helps, I guess, on the demand side of pricing. We are seeing, I would say, larger transactions. And I know with Fannie Mae and Freddie Mac and other investors too, equity developments, maybe we're looking for equity in the $30 to $50 million range. And now talking to syndicators, they're seeing properties maybe in the $75 or $100 million range for equity ask. So I think size of the projects and Fannie Mae and Freddie Mac's willingness to look at bigger, larger developments is certainly helping stabilize that pricing.
Yeah, I'm going to be curious later in our discussion to get your thoughts on it, looking into your crystal ball as to what equity pricing might be like next year. Because I do feel like this year is a bit of a odd situation with Fannie and Freddie getting the extra billion each. A number of bond transactions actually getting pushed forward from 25 to 26 because in 26 there are 25% test versus 50% this year. In other ways in which the market is it at a next normal. Like you said, not only is the price getting discovered, there's price discovery, but there's also the market itself is in a transition phase. But let's turn now to the other tax incentive that did benefit from the One Big Beautiful Bill Act, or at least one other tax incentive. Opportunity zones benefited pretty tremendously as well and others, but we're focused here on the 4 tax credits that we talked about, at least the 4 groupings of tax credits. The One Big Beautiful Act did make the new market tax credit permanent, and that at the same allocation level of $5 billion. As I noted, it's $5 billion a year of allocation issuance authority or equity issuance authority, and that ends up translating to just under $2 billion in actual tax credits a year. But with the tax credit being made permanent, what are you saying in terms of equity pricing, Brad?
Yeah, so I've been waiting for this moment for nearly my entire career. New market tax credit was enacted right after I started at Novogradac. And obviously we were very excited to see it made permanent in the One Big Beautiful Bill. And while we had hoped that there were going to be other provisions included from the New Market Tax Credit Extension Act, obviously permanency was the penultimate provision that we would like to have seen included. So with permanency, I think it's going to provide some stability for the new market tax credit industry to allow for investors and CDEs to really focus on their long-term planning for potentially investors who may have been on the sidelines to decide to come into the new market tax credit market. And I think all of us will talk about tax credit pricing is that investors start to show you what pricing will be based on what they expect in the near future before that actually happens. So we have a $10 billion round that will be awarded at some point in the near future. And I think that you've already started to see investors start to adjust their pricing to anticipate the increase in supply of tax credits. And so you've actually seen tax credit pricing start to trend downward this year, really in the second half of this year. Over the last probably year and a half to 2 years, it's been in that 78 to 80 cent range. And we're starting to see term sheets on transactions closer to the 75, 76, 77 cent range as investors are starting, I think, to anticipate that increase in supply from not only the $10 billion round, but also taking into account many other factors that we'll probably touch on throughout today's podcast.
And for our less frequent listeners, the $5 billion is the annual amount. And over the years, the CDFI fund that allocates and awards the credit issuance authority, got a little bit behind. So the $10 billion round is a combination of two $5 billion rounds. And Brad took a leadership role in helping convince the CDFI fund to make that change. So thank you for that. So it'll be a temporary $10 billion, then we're back to $5 billion. I've heard anecdotally that a number of investors in new markets are, now that it's an indefinite part of the tax code, that they're looking at it and saying, okay, now I can build up my teams, I can build up my staff, I can incorporate this in longer term planning. And that's expected to bring stability to the market, more stability.
Yeah, I've heard the same thing. And you're hearing that really across the entire industry, not just investors, but CDEs, professionals, even qualities, I think, are the ultimate beneficiaries of the program are doing the same thing. So I think all of that will ultimately lead to a more efficient and effective credit market for new market tax credits.
And I am looking forward to the equity panel at our New Markets Conference in New Orleans next week, along with a lot of the other festivities.
And I'll be moderating that panel amongst other things. So I look forward to having everyone joining us there.
So Brad, you also work in the historic tax credit space. And I guess as listeners know and our audience knows, in my intro, I didn't mention anything about historic tax credits. And that's because unfortunately, historic tax credits and the HTC Go bill, none of those provisions were incorporated in the One Big Beautiful Bill Act. So there wasn't any change in the historic tax credit. So with that said, what range of pricing are you seeing with historic tax credits right now?
Yeah, I think unlike new market tax credits where the price range is pretty narrow, I would say historic tax credits is more like LIHTC pricing and that the range can be wider. I think we've seen pricing anywhere from the high 60s to the low 90-cent range. And it's really deal specific. And I think it continues a trend that we've seen ever since the historic tax credit went from being a 1-year tax credit to a 5-year tax credit, claimed over 5 years. And when that change was made, we saw obviously a downward adjustment in pricing. And obviously, as you mentioned, one of the things that did not get included in the One Big Beautiful Bill was a change to revert the historic tax credit back to a 1-year credit. And so as a result, because that didn't happen, we really haven't seen much change in pricing because circumstances haven't really changed for historic tax credits. So again, it's very deal specific. It's very bar sponsor specific in terms of whether you're on the high end or low end of the range, I would say it's pretty similar to LIHTC in that regard.
Well, it's certainly relative to LIHTC in new markets. There's a lot more business risk associated with historics, and historics can be, the size of the transactions can vary pretty widely. And then a lot of the transaction costs and the syndication costs are the same, irrespective of the size of the equity check. So the smaller the equity, the lower the net equity that can make its way to the project. So there's definitely a lot of factors with historic tax credit that makes it unique. And I would just add, in addition to the going from 5 years to 1 year, the whole basis adjustment 50D income came into being, and then the historic Boardwalk Hall case, or the number of factors that ended up. And the other thing I would just note with historics is the expectations of cash flow have a notable impact on the equity pricing and new markets, and local tax credits don't really have that aspect to it, but renewables do. So with that, let's talk about renewables, Tony. Great. We've discussed this as part of our Renewable Energy Tax Credit Finance series about the changes in the One Big Beautiful Bill Act. And I will include some links to various podcasts that you've been on in the past about the One Big Beautiful Act and some of the adverse changes to the various clean energy provisions. And there are so many changes. We just even asked you to give a high-level explanation of changes. It's quite the task. But if you at a super high level can discuss some of the key changes in the sense as to how they will be affecting the equity markets.
Yeah, sure. I'll do my best to keep it brief and high level and on point for the bulk of our listeners. So with respect to clean energy incentives, I think it's helpful just to note that energy in this country has become highly politicized. And for those of us who've been working in the energy sector for, at this point, decades, we're used to seeing energy policy change depending on which party is in control of Congress and who's in the White House. And so under the Biden administration, the Inflation Reduction Act was passed, and we saw the largest increase in support for clean energy incentives that we've ever seen. And then it was really no surprise for those of us who, again, specialize in the energy sector to see under the Trump administration or Republican-controlled Congress that the OBBBA or OB3 sought out to undo a lot of the Biden era past incentives for clean energy. So some of the more relevant provisions that I think are of the greatest interest to our listeners involve the acceleration of the phase out for tax credits generated by wind and solar facilities. And so for wind and solar developers, the phase out is accelerated to 2027. So you need to place your wind and solar projects in service by the end of 2027, unless you can show that you started construction on or before certain dates. And then the OB3 also implemented new foreign entity of concern requirements, aka FEOC requirements, and those for most taxpayers start to take effect starting in 2026. And so that's a complex set of rules that taxpayers will have to comply with. It basically prohibits projects from receiving any material assistance from countries like China, Iran, North Korea, and Russia. Okay, but I think for all things considered, we're talking about China, right? So you get FEOC requirements that are on the horizon, and you could grandfather to avoid FEOC requirements if you start construction on or before a certain date. We're still waiting for some guidance there. We're also waiting for additional guidance just on how to implement all the various rules under FEOC. And then we've got a couple of credit programs that have already expired under the OB3, right? So you've got clean vehicle credits expired on September 30th. You've got previously owned clean vehicle credits also expired on September 30th. You've got the residential credit under Section 25D expires at the end of this year. So you get some acceleration there as well. Another thing I will point out, though, which again, this kind of plays into tax equity pricing. If developers started construction before 2025, they actually still fall under the old credit provisions of Sections 45 and 48. And old Sections 45 and 48 are unimpacted by OB3. So we have a lot of developers, particularly well-capitalized developers, that actually started construction on a significant pipeline of assets where they will be grandfathered under the old Section 45, 48 rules through 2028 is what we're hearing from many of your larger, more well-capitalized developers. And then lastly, on the OB3 impacts, once the bill was passed, the White House issued an executive order calling for revised guidance on how taxpayers can show that they start construction to meet certain place in service deadlines for wind and solar facilities. And that notice, the IRS issued a notice in response to the White House executive order back in August, and that changes the rules for how wind and solar developers can demonstrate that they started construction. And essentially what they did was you used to be able to demonstrate started construction either by incurring at least 5% of your eligible basis costs or by commencing physical work of a significant nature. Well, this new IRS notice that came out, for the most part, did away with the ability for wind and solar developers to take advantage of the 5% test unless you're a solar developer building a facility that's under 1.5 megawatts AC. Okay. And previously, most developers and investors favor the 5% test. That's, for the most part, no longer an option. And so these days, developers, again, for wind and solar, they're stuck with the physical work test. I'll note that a lot of the acceleration of phase outs, it's really geared towards wind and solar. If you're a developer of battery or fuel cells, geothermal, et cetera, you're still working under the pre-OB3 phase out timeline. So you expect to see, and we see a lot of battery storage deals in particular. So the good news is that other than wind and solar, a lot of these other clean technologies are impacted in terms of their phase out timelines. And then a lot of clients obviously ask us, how does this all impact transferability? Tax credit transferability, again, that came out of the Inflation Reduction Act, It's become a very popular mechanism for monetizing clean energy tax credits. The fundamental mechanism for transferring tax credits remains the same under OB3, except for the fact that you can't transfer credits to a foreign entity concern, or you can't be a foreign entity concern and transfer credits.
So with respect to the beginning of construction guidance, because one question that everyone ends up asking is, well, how quick is the phase down? So the beginning of construction, as I recall, is 1 year from July 4th, from when the bill was signed. So renewable developers need to begin construction, and for the most part, of a physical nature, by January 4th of next year. And how long is the typical development phase, or said differently, for how long will these projects be out there in process with credits coming?
Right. So if a developer starts construction, let's assume under the physical work test, before July 5th of 2026, then they're not subject to that 2027 cliff date of getting their facility placed in service. They have until the end of the fourth calendar year following the date they start construction to get their facility placed in service. So if you start construction, say on July 3rd, 2026, you're out, you got basically 4+ years to get your facility placed in service. If you start construction after 1 year from the date of enactment of OB3, then, well, you've got to get your facility placed in service before the end of 2027. So starting construction before that 1 year of enactment is very important to give yourself a couple extra years to get your facility placed in service. So I imagine that already you've got a lot of sponsors, developers that started construction before 2025 that have deep pipelines of assets that are grandfathered under the old Section 45 and 48 rules. Those projects, you'll see some of those getting placed in service even into 2028. Okay. And then you'll start to see the facilities that start construction that are under 48 cap E and 45 cap Y, those will, if to the extent they start construction before January 5th, 2026, you'll see those for many years to come. Okay.
Right.
Even well into when you might get a different party in office, different control of Congress, all that kind of stuff. So
no, that's the important part of that, is it is pushed out, and we have a congressional election and then a congressional and presidential election during that period of time. So one thing for sure, things will be different. In 24 and 48 months, we just don't know which ways and how maturely different they'll be. So we talked a lot about the market more generally. So what does it mean for equity pricing?
yeah, great. So all these place in service dates and which credit provisions you fall under impact pricing. And so right now, we're still not really seeing a lot of 48 cap E and 45 cap Y term sheets getting executed. You're still seeing mostly financing commitments that were entered into pre-2025. So just in terms of let's talk volume then to pricing. Just in terms of tax equity volume in the clean energy space, through the first half of 2025, we've actually seen a noticeable increase compared to the first half of 2024. And in terms of pricing, we've seen pricing hold steady.
Okay.
So again, this is pricing related to, again, financing commitments that were executed prior to 2025. The price, I monitor tax equity closings throughout the year, and I can look at the last 12 months, and pricing is pretty level. As a matter of fact, pricing is, compared to a year ago at this time, if anything, the pricing is probably edged up about a cent. Average pricing for fixed flip ITC transactions are right around $1.10, with after-tax return on investments to the investors of somewhere around in that sort of like 18 to 20% range, which is still pretty comparable to what we were seeing about a year ago. And in terms of volume, just in terms of overall volume, I think our intel suggests that for the clean energy sector, we'll probably end up, at the end of the day in 2025, have somewhere around a 20% increase in tax equity volume for 2025 compared to 2024.
And I would know for our audience that when we're talking about the equity pricing and the differences among the different credits, know that some have a basis adjustment, some don't, some have a 50% basis adjustment. And in essence, some are fully taxable credits, some are in essence a 50% taxable credit, and some are non-taxable credits. That obviously affects the pricing. And then also when you're looking at renewables and historic transactions, you're generally also looking at an interest in cash flow as well. And obviously, if you're expecting cash flow in addition to the credits and tax losses, you'll be willing to pay more. And then there's other factors as well that go into those differences. If I just wanted to lay those out there in terms of anyone out there wondering why we're talking about differences and what some of the ranges and causes of the differences are. And there are just some of the sort of key ones. And the other just general observation I would make, which I'm pretty sure you agree with, Tony, is that initially, some of the non-clean energy tax credit markets, those developers are wondering, well, we get all these renewable energy investors because of the phase down renewable energy. And my sense is there's definitely anecdotal stories of that happening, but not in any sort of large wholesale way. And there's a lot of track still to run, a lot of runway left on renewables, such that a notable shift probably isn't happening anytime too quickly.
I agree with that.
Yeah, we get that question all the time in the new market space, specifically of what impact will the changes to the renewable energy credits have on the investor appetite for new market tax credits. And I think it's too early to tell for all the reasons that Tony, you just went through, is that there's still plenty of time, plenty of runway to absorb a lot of investor appetite with renewable energy credits. And I think one of the things too, Mike, I would add to your list of factors is just certainty, or put another way, uncertainty of the future. Investors who are looking at credits that have a longer period to claim them over have to have a lot more certainty of what their appetite will be based upon their income and tax liability, right? And right now, I think a lot of investors are looking 2-3 years forward, and especially at the end of this administration, have a lot of questions of what that impact might have on their future income and future tax liability. So I think that uncertainty is definitely having an impact on investor pricing and investor appetite for credits that might have longer periods in which they're claimed over.
Along with also the present value difference of a 1-year credit versus a 5-year
Right.
credit, it's the 7-year credit versus a 10+ year.
Exactly. Exactly.
We got them all. What period of time do you want to claim the credits over? So Dirk, let's get back to you. And you shared with us your thoughts on what you're observing with 2025 tax credit markets. Now let's look into the future. The 9% will be in practicality, there'll be 12% more 9% credits allocated. And there's potential with the existing private activity bond authority to do twice as many private activity bond transactions. What does that portend with respect to equity pricing for locally tax credits next year and beyond?
Right. So I think 2026, especially the first few quarters of 2026, will still be in that transition period of, okay, how many projects were likely going to close in 25, but didn't close in 25 and now got pushed into 26. The private activity bonds can be carried forward up to 3 years. Assuming that they weren't expiring at the end of 2025, they can be carried forward into 26. So there isn't like a definite cutoff where project has to close by the end of 2025. So we may see some projects close in the first quarter of 26. Talking to investors, geography, CRA, that still matters. It's not like that's going away. So if you have a desirable property in a CRA market, and depending upon when that financial institution's CRA cycle closes, could be favorable for pricing as well. So I think we'll still have the differences of CRA pricing, non-CRA pricing, projects that are more straightforward with not 10 layers of financing and are in, again, good areas that investors are looking for. They're still going to command those higher prices. But overall, it sounds like that there may be if there is a slight dip, there could be a slight dip in the first or second quarter, but based on LOIs for projects that I'm seeing, the dip isn't as big as some were originally forecasting. And I think bonus depreciation is back, 100% expensing. And one thing that I'm seeing back as well are bonus depreciation adjusters.
Yes.
So those bonus depreciation adjusters went away when it was 40% or going to be 20% bonus. And now that it's 100%, bonus depreciation matters, especially if there's that adjuster in your partnership agreement. So make sure you're reading all of your adjuster language, all the adjuster language in the LOI and the LPA. To make sure that you have a firm grasp on what adjusters are out there.
That's an excellent point about the bonus depreciation adjusters making their way back in, because that's also something that it shows you how important the forecast is for the developer and making sure that you're thinking about cost aggregation studies and the rest so you can maximize that depreciation number and also be clear within your whole team what your place in service dates targeted to be and the rest so that you can get the maximum benefit to that. But as you were mentioning, then making sure that what's in the LOI is achievable.
Right.
And that your team knows that's what you're agreeing to. And then obviously the reason why investors are putting that in there is they're paying up for the equity. So you're getting the benefit of those losses. So now you got to deliver them or else there'll be an adjustment. There's lots of reasons why you need to be working with your tax accountant during the negotiation phase of a LOI. And this is just one more reason why you want to make sure that, those that are ultimately going to be preparing the tax returns agree with the achievability of those losses and also make sure you're not underestimating them such that you're not getting pricing that you could be getting. And it's hard for me just to layer in. It's so hard to know what the impact of Fannie and Freddie's $1 billion extra each is. It's hard to know I don't expect any CRA changes, green reinvestment changes where that could happen. The Road to Housing Act would increase the public welfare investment. So some banks are getting limited how much public welfare investment they can make, and freeing up more banks, particularly medium-sized banks, to invest could be helpful. Where are interest rates going? Where's the economy going? I feel like if you told me all these other factors, what was going to happen, I feel like I could do a pretty good job of the equity pricing. Without all those other factors, it's daunting to say the least. So Brad, how about new markets tax credit equity pricing going forward, looking into next year?
Yeah, like I said before, I think the pricing has already started changing as a result of what's going to happen next year. As we talked about with awards forthcoming, hopefully sometime soon for $10 billion in new market tax credit allocation, you usually see the market close about $5 billion a year over the last couple of years. I think that there will be an increase in the amount that is closed. I can see investors and CDEs favoring larger transactions with the greater amount of new market tax credit allocation that will be available. And I think that for all of the things that Dirk mentioned, the easier it is to close, the cleaner the transaction it is, and so forth, garner better pricing. CRA factors into new market tax credits as well. I think your caveat of we can consider all of these other factors that could change in the future, but as of right now, if nothing changed, I think the pricing's already been set for next year in that kind of mid 70-cent range. And so I don't really expect a whole lot of change between now and then, unless all those other factors change as well. So I think going into 2026 we've already seen what that change will look like.
No, you look at a $1 credit, since it's taxable, you have a 21% tax rate on the gain. It ends up being a pretty effective price. So how about historic credits? I suspect you're going to say not much is expected to change there because not much change as part of the One Big Beautiful Bill Act.
Yeah, exactly. With no real changes to it. I think of all the credits, I think that it is least likely to see a lot of increases or anything like that in terms of appetite and for all the different characteristics of a project that Dirk mentioned for LIHTC, I think applies to historic tax credits as well. There's been this trend, I think, of less investor appetite for historics. And so you haven't been seeing as many, for example, term sheets on a single project. There has been discussion about the asset classes that are using historic tax credits and how that may change as you're looking at an overall change in the real estate market of taking commercial real estate and converting it to housing. And so historic tax credit deals that have some kind of housing component, you may see greater interest in the future. But otherwise, I would say there's probably not a whole lot of change in 2026 in terms of what historic tax credit pricing will look like.
Well, historic tax credit is what comes to mind when I think about the list I gave before about different factors that could affect equity pricing next year. And I need to know what the answer is to those. One of those factors would be, is there another tax bill? And if so, what's in the tax bill?
Right.
And if there is another tax bill, it sort of seems like those provisions, like the historic tax credit that weren't in the One Big Beautiful Bill Act, but were close to getting in, could be in. And then obviously that would end up having an effect on the historic tax credit equity pricing in some fashion based upon what the change was. I know one of the things that we talked about last week at our historic tax credit conference in Cleveland was moving from a 5-year credit back to a 1 year. And that obviously have a pretty dramatic effect. And hopefully when we're in St. Louis next year in October for our historic tax credit conference, we'll be able to talk about that actually happening.
Yeah. And like you said in some of your articles, I think if we can increase the investor base, ultimately that will increase the demand for the tax credits. And that can be in sometimes easier way to affect pricing than to some of these other legislative changes by making it easier for investors to participate. So I think if any of that happens, obviously on any of these credits, I think you'll see an increase.
So Tony, you mentioned the equity market in 2025 being roughly 20% higher than 2024's rough estimates. What are you seeing in 2026 and 2027? I know if you go out far enough, it's going to dip, but how about the next couple of years?
Yeah, I expect 2026 to still be another strong year in terms of facilities getting placed in service and financings getting closed. As far as pricing goes, I would expect those grandfathered Section 45, 48 transactions to just maintain real strong pricing. And as the supply of those credits starts to dwindle, that pricing will stay even firmer. I think developers that have deep pipelines of assets, they may even be tempted to accelerate the timeline of some facilities that originally they were thinking they were going to place in service 3 years, 4 years from now. But once they start to see the price, I think the price difference for vintage 48 and 45 assets will be stronger than the tech neutral credits that are subject to the FIAC requirements, enough so that you could even see some developers that have a mix of both types of credits in their pipeline. They may even try to do things to accelerate the timeline of their kind of vintage 48, 45 credits just so they can get that better pricing from tax equity. I think in 2026, you'll start to see some developers that weren't able to start construction before 2025, okay, or even start construction before 2026 to avoid FIAC requirements. And so you'll start to see some smaller developers that'll have some facilities that are subject to the FIAC requirements, and they'll be out there looking for term sheets. And I suspect the pricing on any tech neutral credits subject to FIAC requirements, you're going to see a real hit on pricing there. Okay. It's going to take time for investors to really understand all the complexities around FIAC and how to underwrite those complexities and get comfortable with them. And until they do so, you have to see a dip in pricing on tech neutral credits subject to FIAC requirements. So look to vintage 45 and 48 credit pricing to remain strong for as long as those assets are available.
So I wanted to move now into what our audience can do if they're a developer to increase equity pricing for their transaction. And I think I'll ask each of you to suggest three ways, 3 actions they could take that they may not be thinking about, or they may be thinking about, but you want to reinforce the importance of it. But 3 actions they can take for each of the various tax credits. And I'll start with you, Dirk. In terms of, I love the tax credit developer. If I'm coming to you and I'm sitting down and I ask you to run a pro forma for me, and I go to you and say, how can I increase my equity pricing with an investor? And I recognize it's all things being equal, or not even all things being equal. I won't put any limitations on it. What do you tell me if you were limited to giving me 3 suggestions?
Well, first, Tony and Brad, you guys are welcome because I get to go first, and you can think of your three suggestions. Credits. So, So I think the first suggestion would be, and when we talked about with bonus depreciation, as we're starting to see, if we start to see ACT rehab projects increase, the amount of ACT rehab projects, typically your percentage of personal property as a percentage of your rehab is higher than personal property as a percentage of new construction. So I think a cost seg study would definitely be worthwhile, not only on new construction, but definitely on an ACT rehab project. Again, this could help a few cents on your pricing, and you can see that in your LLI. The other thing I would say is if you can delay when the equity comes in, I think we're going to see this more and more. If there's other types of soft financing that you can get upfront, use that other financing first, especially if it's a low interest rate or no interest rate. To the extent that you can bridge that equity or find other financing to bridge that equity, the IRR does matter. And pushing out the equity, even a quarter or 2 quarters, that can move the IRR and have a significant impact. And then the third thing I would say, look at your QAPs, look at the new QCT and DDAs that were just released, try to maximize the equity and the desirable of your project to increase your pricing. So obviously if you're in a QCT or DDA, you get 130% basis boost. Those were just released, so make sure to check out the mapping tool. I think 3,000 areas have changed. So your property could now be in a DDA as it wasn't previously. But that's definitely something to look for.
No, I appreciate the delaying equity. I appreciate starting off with the cost segregation study. That seems like a natural. And then I really like your pointing out the delaying of the equity. Because to a certain extent, it is the equity. And obviously equity comes at a higher cost, higher yield than other sources of capital. So to the extent you can delay receipt of it, you're not borrowing as much of it for as long. It translates in terms of more equity dollars. That's excellent. And I also appreciate your pointing out the change in the DDAs and the rest, because that's one where if they come to you with your project and they haven't applied yet and they lost their DDA status,
Right.
your advice would be there are certain steps you can take now to make sure you get those 30% credits.
Right.
And then the opposite could be the case where you're like, well, if you wait a bit, you can get 30% more credits. So of your 3 solutions, not losing the 30% boost or gaining the 30% boost is obviously the most valuable of those 3.
Definitely.
So well done. Brad, I'll turn to you and start with new market tax credits.
Yeah, so I think for new market tax credits, the first one I would say is demonstrating impact, right? So for new market tax credits, so much of what CDEs and investors are interested in is the actual community benefits that will be delivered by the project. And I think the ability to talk about those impacts, but also know what types of impacts are the most important, especially in the current environment. We know that jobs are important, that rural transactions are important, that transactions that generate lots of economic development are important. And I think that CDEs and investors will be much more interested in those types of projects because ultimately they want to be able to put them in their application as they apply for tax credits in the next round. So I think being able to demonstrate that impact is important. I think demonstrating readiness and the ability to close quickly is important. There's somewhat limited capacity to close transactions each year, and the ability to know when to start that closing process, but also have everything lined up to make that closing process easier and know that it won't have to butt up against a deadline that every other transaction is trying to close by. If you can close on a different, more accelerated timeline or an earlier timeline, we've seen increased credit pricing related to that. I think too, shopping the investors in the new market tax credit market is somewhat easier to do. And we've talked about CRA. CRA obviously impacts investors. And we've seen in certain areas, knowing whether or not you're in a CRA market can help with increased credit pricing as well. So I think being able to shop those, we've seen different appetites between investors at different times. And so just because one investor was at a price last year doesn't mean that's going to be what their pricing is this year. So I think shopping around is also helpful.
Excellent. Thank you for those suggestions. When you think about historic tax credits, what do you think about there? And I will say, if they came to me, one of my three, and that's why you're three, would be see if your state has a state historic tax credit.
Absolutely.
Oftentimes, go ahead and explain why that would be more of a thing with historic credits.
Well, I think that obviously additional benefits are helpful for any type of project, and being able to layer different tax credit incentives to it so that an investor can get the benefits from multiple incentives is helpful. And I think what we're seeing with historic tax credit transaction is the need to layer more incentives. And if you can do that strategically, that not every incentive is created equal and every incentive comes with its own strings, and understanding what those are. Sometimes it's not good to add a certain incentive or source of financing to a transaction because it may make it more difficult to interact with the other sources of financing. So I think understanding that and doing that strategically is important. I think also the asset class for historic deals can be important too, in terms of what investors have an appetite for and can underwrite and understand. And this one may not be something that you can control as much, but having a strong guarantor on a historic transaction, I think is extremely important. We've even seen that on LIHTC deals too. We've heard investors say, we only are going to invest so much in LIHTC, and so we're only going to invest in those that have strong sponsors with them, right? And so I think that's the same with historic tax credits as well.
No, good suggestions. And I would just say, I mentioned the state historic credit because I feel like with the low tax credit, most developers there are doing it on a regular basis, and they know if their state has a state historic credit or not. That won't come as a surprise. But historic tax credit developers, oftentimes, there are very few that are just historic. They're using historics as a source among other sources, and may not be aware of what's available.
And I'll say there may be other state credits available that are similar to historic, but they're not historic tax credits that can be layered in as well.
Yeah. That's very important. It's not just does this have the name historic in it?
Right, right.
Availability. So, Tony, if I come to you with my clean energy transaction, and I'm asking you for 3 tips on getting better equity pricing, what are part of your 3 tips?
Great. So I'd start with how you start construction. And so developers they're inherently motivated to want to save money on how they start construction to preserve capital, but that can ultimately cost them in the long run in terms of their financing options with third parties. So I would say I would definitely look into the physical work of a significant nature test. And I would try and do that as textbook as possible. So the IRS has clear guidance there in terms of what they allow for under that test. And I wouldn't try and skirt around that in any kind of manner. I'd really try and stick to color in between the lines there with respect to the physical work test. And I do that as soon as possible. And to the extent you can actually get construction permits, I would also try and do whatever you can to quickly get construction permits, because I perceive from that White House executive order that they value construction permits as part of your demonstration of starting construction. So a lot of developers like to do physical work with offsite activities that doesn't require a construction permit. Okay. But to the extent you can get a permit, I try and do what you can to get that permit pulled. The next thing I'd recommend is in the renewable energy space, tax credit buyers and investors, for the most part, expect tax position insurance. And these days, the tax position insurance market has gotten a bit tighter in terms of what insurance providers will cover. And if you can get a tax position policy, a fully wrapped tax position insurance policy, that's an indication that you've really mitigated the most significant perceived tax risks in one of these transactions. So I think if you can make sure you not only get tax position insurance, but like a fully wrapped policy, I think improves your the financeability of your project. And then the third tip I would recommend is building off one of Brad's points with respect to looking into your various sort of financing options. But it's these days, tax credit syndicators or investor sources, they're looking to provide more than just tax equity. Some of these equity providers are looking to provide forms of debt, whether it's construction loans, permanent loans, tax equity transfer proceed bridge loans. More of your tax equity syndicators are offering more and more different forms of financing to developers. And if you're a developer that's open to going through like a one-stop shop kind of financing approach where you're getting your tax equity from them, as well as some kind of tax equity bridge loan or construction loan, I think you might be able to get some more favorable pricing overall by going to one shop.
Great. Thank you for that. And there's so much more I know each of you could share on the status of the equity markets. And I know that Brad will be sharing more on the equity markets at our conference in New Orleans, our New Market Tax Conference in New Orleans next week. And there'll be lots of equity market discussions, Tony, at our Renewable Energy Conference, first week in November in Washington, D.C., and then similarly in Las Vegas at our Long-Term Tax Credit Conference. There'll be ongoing discussions there. We just had this series of discussions on that in our conference in Nashville. I invite everyone who's a member of this audience to reach out to Brad, Dirk, or Tony for any additional questions that you have. And I will include their contact information in the show notes. I also encourage you to join either the New Market Tax Credit and or the Low-Income Housing Tax Credit Working Group and or the Renewable Energy Tax Credit Working Group, any of those three working groups, and you'll get to talk to Brad, Dirk, and or Tony once a month. And you can't put a value on that. And before we bring this to a close, I do want to encourage our audience to consider subscribing to Tax Credit Tuesday or whatever platform you get your podcasts. And if you're watching on YouTube, please subscribe as well as like and comment on the video. And please share the podcast with your colleagues to help them keep abreast of the various tax credits that we discuss on the podcast. Brad, Dirk, and Tony, thank you for being on the podcast today. I will give each of you one last opportunity to comment, and anything you might want to share in bringing this to a close. And I won't start with Dirk. I'll let whoever wants to say a few words, then we'll rotate around, and then I'll bring it home.
Yeah, I'll go first. I'll just say I'm glad I didn't have to give the one big beautiful bill update that Tony did. Mine was much easier, but I hope that we'll see a lot of listeners in New Orleans next week. It will be a celebration, 25 years, permanence, amongst other things. So I hope to see many of y'all there.
Great. All right. And so, yeah, these days we are super busy trying to help developers show compliance with the various aspects of the IRA and OB3, et cetera. So whether it's financial forecasting or complying with prevailing wage and apprenticeship criteria or the domestic content adder or now the FIOC requirements, reach out to us. We have teams of professionals that specialize in these various areas and we'd love to work with you.
Great.
Yeah, echoing what Tony said, my group does provide a lot of upfront services, looking at the forecast, looking at how to maximize various provisions that are in the one big beautiful bill. You definitely want to know, or you want to be doing what everyone else is doing, even more. So you don't want to be left behind because we're including bonus depreciation on certain assets or things like that. So yeah, please reach out. I'm happy to work.
Great. Thank you, Dirk. And thank you again, Tony and Brad. And to our audience, I'm Michael Novogradac. Thanks for joining us.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.